Welcome back. It's time to recap what's happened in the market this week again. There have been some crazy swings, but in this episode, we're going to go through how long do bear markets and recessions typically last. We're going to look over, sort of the GDP growth during recessions or declines, what that looks like. Then the next big catalyst we're going to be having is earnings, which is starting soon. The first company reporting earnings in my portfolio is ASML on Wednesday of next week. Then we have a couple more after that. And we'll look at the fear and greed index, which, yeah, we're in extreme fear right now. We're also going to talk about Amazon, who recently had their annual shareholder letter, and they talk about their AI investment mission. So we're going to take a look at that and what that means for some of the companies that I own. And of course, at the end, I'm going to share my portfolio, how I'm feeling about it, how it's been performing, everything I'm buying, and what I'm doing. Before we get started, I want to share some of the crazy swings I've been experiencing in my portfolio. I have this Robinhood widget on my phone, and this was not this week, but last week. I was down nearly 10% in a single day. But then this week, the exact opposite happened. I was up over 14%, almost $10,000 in a single day for a portfolio my size is nuts. And that's largely due to this. This is the list of the largest daily changes in the NASDAQ. The second largest day happened April 9th. The NASDAQ was up 12%. So, yeah, these are historic times, honestly. And lastly, I wanted to share a funny meme that I saw, and it's so accurate with the market right now. Tax on, tax off. I'm sure someone will enjoy it. I know I did, at least. Okay, now let's jump right in. So how long do bear markets and recessions typically last? There's been a lot of talk about bear markets and recessions recently. So with all the uncertainty going on right now, and with the big swings, we already know, I'm sure you've seen the data. If you miss just the 10 best days in a 30-year period, it dramatically affects your performance. And that just shows like you don't want to miss that 15% positive day, or else you just kill your returns. So during these times, I'm taking a step back and just thinking long term. And I want to share some data that should help you feel at ease as long as you have a longer term time horizon. So this article goes on by saying the S&P 500 peaked February 19th and then began slipping as Trump rolled out tariffs on Canada, Mexico, and China, aluminum, steel, and autos. The sell-off gathered force after he slapped reciprocal tariffs on almost every country on April 2nd, and China retaliated. In all, the S&P 500 fell 19% through midday Wednesday, just before Trump announced a 90-day pause on the recent reciprocal tariffs, except on China. The stock market meltdown that accompanied President Trump's intensifying trade war in recent weeks was unsettling enough. The fall in the dollar and rise in bond yields that went with it have been truly ominous, so ominous it might be why Trump changed course, at least temporarily, by pausing some of his tariffs Wednesday. Historically, during periods of market turbulence and economic uncertainty, investors typically seek refuge in safe haven assets, with U.S. Treasury bonds and the dollar being the traditional gold standards of security. However, despite growing recession concerns, we're witnessing an unusual phenomenon. The expected flight to safety in dollar-denominated assets has failed to materialize as strongly as anticipated. This unexpected market behavior stems from multiple factors. Some are short-term considerations like inflation risks that erode real returns, while a more fundamental shift may be occurring in how global investors perceive America's economic stability in the current political climate. Adding to these concerns, Jamie Dimon, chairman and CEO of JP Morgan, the biggest U.S. bank, has signaled that a potential economic slowdown may be coming in the second half of this year. While this has sparked concerns among investors, understanding the typical duration of bear markets and recessions can provide valuable context for making informed financial decisions. So that's what we're going to be looking at. How long do these bear markets last? And, just some considerations to make. So first, they define the terms here. So I figured it would be good to read through this. Bear markets occur when major stock indices fall at least 20% from their recent highs. Recessions, on the other hand, are typically defined as 2 consecutive quarters of declining economic activity, though the National Bureau of Economic Research, NBER, uses a broader definition that considers multiple factors. And here they say bear markets typically last around 9 to 12 months on average, while recessions generally last for about 11 months, according to the NBER. Then a little further down, they highlight that not all bear markets are created equal. They can be categorized into 3 main types, each with distinctive characteristics and recovery patterns. So we're going to go through these and look at the one that most accurately reflects the conditions we're in today. First of all, a cyclical bear market are tied to the normal business cycle and economic contractions. These typically last an average of around 2 years and take about 5 years to fully rebound to their starting point. These are the most common type of bear markets and often present buying opportunities for long-term investors who can weather the volatility. Then we have event-driven bear markets, which, in my opinion, most accurately represents what we're going through today and the volatility we're seeing today based on, events. So event-driven bear markets are triggered by specific, often unexpected occurrences such as wars, pandemics, or oil price shocks, or tariffs, like we're seeing today. These tend to be shorter, lasting around 8 months, and recover in about a year. The COVID-19 market crash of 2020 is a recent example of an event-driven bear market that saw a remarkably swift recovery. Yeah, with the COVID crash, I think the market had already recovered within a year. And arguably, that was a much bigger deal than what we're going through today. During COVID, we were talking about closing down the worldwide economy for years. Here we're talking about some taxes or tariffs that, as we have seen, and as I've been saying for the past couple of weeks, can go away just as quick as they, came up. And lastly, we have structural bear markets, and these are more severe, resulting from fundamental economic imbalances in financial bubbles. The 2008 financial crisis and the dot-com crash of 2000 were structural bear markets. These can take many years to fully recover from and often lead to significant regulatory and economic reforms. So out of these three, the event-driven bear markets, what I think most accurately describes what we're going through now, last the shortest. They tend to last around 8 months, they say here, and recover in about a year. So if you can think 2 years ahead, and I'm personally thinking 5 years, 10 years ahead, this is just something that you keep buying, which is what I'm doing. And if we just make it as simple as possible, if we just look at the data, every crash in the market has been a buying opportunity. People will say that this time is different, and they do that every time, but it's never been different. The market has always gone higher in the next couple of years after that. So that's what I'm betting on happening. So I'm continuing to buy every single week, and I'm getting great companies at huge discounts. Next up, I want to look at the GDP growth of the US during these, recessions or bear markets or whatever. So if we look at some of the recent crashes, let's look at 2008, 2009, right here. So GDP growth, 2008, GDP growth was 0.1%. It was actually up. 2009, it was down, but it was only down 2.6%. So the stock crashes can be dramatic, but the overall spending of, American citizens doesn't drop that much. If we fast forward a little bit, 2020, GDP growth was down 2.2%. Everything was shut down. We're talking about the worldwide economy shutting down for years. It was a very scary time, but GDP growth was negative 2.2%. That's not a lot. Let's look at 22, the crash and the whole inflation crisis that we were going through. With the Federal Reserve hiking interest rates, up 2.5%. So it just shows that there are all these worries about earnings and companies doing worse during periods of uncertainty. But if they do worse, or if the overall economy is doing worse, it's never that bad. And it just goes back to the psychology of investing. When everything's green, there's no uncertainty, everyone's piling into stocks. But then when things shift to the negative, the swings can be so massive and over exaggerated and unreasonable. So, as an investor, I personally think that one of the most important things, regardless of reading financial statements, listening to earnings calls, and all of that, is just your temperament and not giving into the everyone piling into the market and not getting scared when everyone piles out of the market. And as Howard Marks, an investor that I study and look up to, often points out, being a good investor is being contrarian, doing the opposite of what everyone else is doing. And if we just look at data, the dips are a buy. So that's what I'm doing. Okay, next up we have company earnings, which are starting next week for my portfolio when ASML reports earnings. ASML is going to be an interesting one. I'm not quite sure what to expect. Last quarter, they came in with great news that their order volume was up a ton. However, with all the uncertainty, not only with ASML, but I think a lot of companies will struggle to even give guidance and might just pass on giving guidance, at least for a lot of them. Some business models have a clear idea of how they can get through this and perform in this, so they might give guidance. But overall, I have a feeling that a lot of companies are just going to not give guidance. We'll have to see how investors react to that. But yeah. So the next week after that, the April 24th, we have Google reporting earnings. Google has obviously been hit massively recently, so I'm excited to see how their numbers hold up. I expect that they will put up great numbers yet again. Obviously, Google is my newest holding. I started adding to that 2 or 3 weeks ago. The week after that is a pretty big week. We have Amazon, which is a top holding, AMD, which is the largest holding, and PayPal, which is also up there. But yeah, April and May are going to be big months, and they're going to be the next catalyst that the market gets in terms of how to feel for the future. Honestly, we've seen how volatile these tariffs can be. So going into this, I'm not even going to make any predictions. I'm not going to, sit down and expect this or that. Whether we go up, whether we go down, I'm just going to keep buying steadily. And if we see, crazy drops like the ones we've been seeing in the past couple months, then I'm probably going to step in and do some outsized deposits and, really load up on stocks. Moving on, here's another thing I like to look at, the fear and greed index. Again, if you want to simplify this game, as Warren Buffett says, when others are fearful, be greedy. When others are greedy, be fearful. People are, we're in extreme fear right now. A week ago, this score was even lower. It's almost as low as we can go. And yeah, if we just look at the past history and the past, data of the stock market, it has typically been a pretty good time to buy when there's extreme fear out there. Of course, this doesn't mean that this perfectly times the bottom of the market. There might be more fear and more uncertainty to come. But if you have a longer term time horizon, let's just say 3 to 4 years to be safe, the past couple crashes and data has shown that we're likely going to be higher than we are today. And here's one more thing to look at, for, I guess, buy signals or whatever, is the VIX, the volatility index. And this just tracks the volatility in the market. And you can see the VIX here is in this magenta, and the S&P 500 is in this blue purple-ish. Every time the VIX spikes, this was in 2008, the VIX spikes, market drops. Any time of volatility, you can see that it has been, just look at this chart. It's been a great buying opportunity. Let me move this. Let's look at 22. The VIX spiked massive drop, great buying opportunity. Throughout 22, you can see it kind of bounces up and down. We didn't see those extreme levels like 2008 and 2020, but throughout this entire period, drop. And as we know, that was a great buying opportunity, especially for big tech companies. And yeah, now we're seeing this spike in the VIX again. The market is dropping. The only other times we've gone this high in the VIX is 2020 and 2008. So how I'm seeing that is it's a great buying opportunity. This is, one of those things that I look at, and just like the fear and greed index, when the VIX is spiking, I like to buy. Okay, next up, we're going to watch this CNBC video where a couple of analysts and fund managers go on and just talk about the overall market right now, what to expect in the short term, long term. This is like the best video I saw all week, so let's watch it.
And that's what I want to talk to you about to start here, Josh, where we are now. Because the damage that the president and the administration have caused to all of this doesn't just reverse in a day. And I think you're starting to see some of that. We still have tariffs, big ones on China. They're going to hurt growth. And that's why recession possibilities are still as elevated as they are. What do you see?
I think this is like the aftermath of yet another bear market bounce. And these things are mentally debilitating for investors precisely because of how quickly they slip away. Yesterday is the 10th best day of all time for the S&P 500. I heard that breathlessly reported everywhere. I saw all the tables, all the graphs, all the charts. What didn't necessarily accompany that commentary was the context in which we've seen the other 9 best days of all time. And I'll spoil it for you. Typically, they take place in years like 1933 and 2008 and 1931. And they happen when the market is in a 75% drawdown. A 48% in October 13th of 2008 was the 6th best day ever. We had a huge 11.6% run. We were already down 35.9% from the high. Yesterday is peculiar in that it didn't take place in a statistical bear market down 20% or worse. It's a little bit shallower than that, but from my perspective, close enough. Horseshoes and hand grenades. The median stock was in its own bear market. Most sectors that matter with market cap were in their own bear market. So what happened yesterday, while it was exhilarating and remarkable and a lot of fun and a lot of backslapping and a lot of rich kids who are really proud of themselves because they grew up insulated from the consequences of their own actions, the end result today is, oh, wait a minute, maybe we put the financial crisis on hold, but we still get to have a recession. So that's how I feel. And I don't want to get too negative, and I'm not out shorting the market, I'm not a hedge fund, but I just want to give people a really accurate picture that this feels more to me like a classic bear market than it does a correction or a dip or a quote-unquote healthy pullback.
Yeah. So
one thing to point out there, all those, historical return or daily returns that he mentioned, 31, 33, whatever years he mentioned, those were all during massive recessions or massive crashes. So as we talked about earlier, the swing back up, it's not always gradual. You'll have single days of 10, 12, 15% upward moves, which is why it makes it so hard to perfectly time this. Like, who could have accurately timed this week's bounce? Accurately, because it was kind of an event that no one expected. It came out of nowhere. This announcement that tariffs are going to be reduced to 10%, and they're kind of being put on hold, except China, of course. Who can, predict that? Who can know that that's coming? Not a lot of people.
Steph, the VIX, which was at 50 yesterday and then got a lot of air taken out of that balloon, is on the rise again by a lot. It's at 42.5. it underscores, where we are. I thought Sarah's point was important, too, at the end of the prior hour. It's the dollar's worst day since 2022. The typical safe havens have not been such. Dollar bonds, munis, for example, which a lot of our viewers, I'm sure, are invested in. I'm wondering what you do in an environment, as I said, the damage that was caused here, the self-inflicted damage that was caused on these markets doesn't reverse in a day.
It definitely does not. There's still a lot of skeptics out there. I didn't see anyone really reverse course that was negative, that went to positive. Numbers are coming down. Estimates are being reduced. They have been for a while. Target prices are getting cut. This kind of after the fact, Scott, to be honest with you. Look, it's not often, and in fact, in 33 years of doing this, I've never been up 9.5% in a day. We know the long-term total return in general for each year.
I've never been up over 14% in a day. So
year is 7.7%. So yesterday was great. I'm not in the recession camp. No, I'm just not. Not with the weekly jobless claims where they are, and you're at 220,000 on a 3-6 month basis. Recession is 350 to 375. Inflation is coming down, not to the 2% we needed to, but it's coming down.
CPI report was really good. And on any other day, at any other time, we'd be like, this is exactly what we've been waiting for.
But maybe, just maybe, we start
on any other day, but it's so hard to talk about inflation right now because we still don't know what's going to happen with tariffs. And increased tariffs is probably going to be inflationary and lead to higher costs for consumers. So I don't know, it's just a weird data point to bring up right now because
start to make good progress on inflation, and then maybe you get the Fed conversation back. I don't know. I don't think we're going to see 100 basis points of cuts, but maybe if we keep getting inflation down, that is a good sign. So I am just not in the camp of recession. I'm in the camp of slowdown. I'm in the camp of, are we flat? Are we up 1%? Okay. Now I want to hear what companies have to say in terms of earnings. Numbers, again, have been reduced dramatically. The stocks are down dramatically. I want to see how they respond tomorrow, starting tomorrow.
You can't expect.
If they cut, how do the stocks react? That'll be very telling to me.
I know, but you can't expect, can you? I should ask you rather than make a declarative statement. Can you really expect that these companies who have absolutely no visibility whatsoever are going to give any kind of guidance on any level that sounds good?
That's the point that I was making earlier. And okay, he's asking if they can give guidance that's at any point or in any way good. But my question is, can they even give guidance at all? Are they going to do that, or are they just going to skip this quarter?
If they even are able to give guidance at all.
No, but I got stocks down that are 25, 30% into that.
I know, but if you're having a recession, they may not be down enough.
But I'm not in that camp. I'm not in that camp. I just told you why. I'm just not. But I have stocks that are down a lot into the print. So the expectations are very, very low. And what is very clear is that Trump and Bessent are watching the bond market. You lose the bond market, you're going to lose everything. And that's why they actually reversed course yesterday, in my mind.
Oh, it's clear that,
So yeah, in response to all the tariffs, the bond market and the 10-year yield spiked. And what's one thing that Trump wants is more affordable housing. You want that 10-year yield down to get mortgage rates down. So I think they talk about a little bit here how much power the bond market has. So, and some people think that the negative reaction from the bond market was might have influenced Trump and the administration.
The bond market's, ruling the day. We learned the lesson of how powerful the bond market actually is yesterday. Some comments from Jamie Dimon talking about recession apparently swayed the president as well. But again, I just look where we are at the screen. You can't normalize in any way what's taking place. Yesterday's rebound wasn't normal, and this activity today, down as sharply as you are, as I said, you got a lot of problems to deal with that were self-inflicted. Business has no confidence in their ability to see anything, okay? The fog may have dissipated just a little bit yesterday, but it's still nasty out. Consumers, You think they're looking at their investment accounts, their 401ks, 529s, pension funds, and feeling great about going out and spending money now?
Yeah. So, I mean, we all know we're a consumption economy. That's 2/3 of.
And that's a good point. Markets going down can almost be a self-fulfilling prophecy. People look at their investment accounts, as they just saw, and look at their retirement accounts, see that they're down a ton. So they're going to be less likely to go out and make big purchases and spend in the economy. So it's a really good point right there.
GDP. And so consumer sentiment, you can say it flips on a dime, which it can, but it definitely, especially with the unrest, can become a self-fulfilling prophecy on top of CEO sentiment. And it's just hard to believe that we're on the precipice of earnings seasons. And I think every company is going to come out like Delta and say, I don't know guidance. How can you say that with a straight face as a CEO? And I think the banks will be really interesting because they're at the epicenter, because they have how much are they going to spend, M&A, et cetera. And so I think we're going to continue to be in this, I still think, this 2018 environment on steroids. And if you go back to 2018, you had 8 drawdowns between 8 and 15%. Half of those drawdowns were between 10 and 15%. And I think what other nugget you have to sprinkle into this is the Fed is not going to come in. There's no Fed put here unless, let's say, something breaks, but there's no Fed put because they're not going to be contra to a strategy or tactics they're not aware of.
No, but if, people were speculating yesterday.
And they're talking about 2018 here. 2018 is the last time we went through these Trump tariffs. So if we want to pull anything from 2018, as they just said, there was 8 to 10% drawdowns or something. So, there might be way more volatility to go, and which I'm actually pretty happy about because obviously I want to buy stocks at cheaper prices. So.
Who just watch markets well, like Mohammed El-Arian, for example, who joined me on Closing Bell, that in his mind, the Fed wasn't that far away from having to do something. Whatever the something is, that's not a bullish environment.
Stabilizing the Treasury market is historically not bullish. Yeah. I would also point out that 45 basis point swing in the 10-year is maniacal. Like, this is not, again, I want to say, oh, it's a pullback, just pick your favorite names and load up. I think you should be a buyer if you have a really long-term time horizon. You should not expect that the buys you make today will necessarily be rewarded a week from now. It's just a different environment. A 45 basis point swing.
Exactly. And for myself, I have a pretty big position in ELF, which gets a lot of their products from China. So in the midterm, I don't know what to expect. I still think it's a great company, and they have this whole tariff playbook to try to mitigate some of the things that tariffs will cause. And they also their products are priced so cheaply, so they can raise prices. So in a lot of ways, they can kind of take the impact out. But over the next 3 years, it's going to be a lot of uncertainty. But what I've been thinking recently in regards to this whole tariff situation, if the average American citizen, the consumer, is feeling bad about what's been going on, and these tariffs truly have a negative effect, they're probably going to vote differently during the next election, and likely we'll see some sort of reversal in these policies. So, there's a lot of uncertainty, but if we look a little further, I'm pretty confident that there are brighter days ahead, essentially.
In 3 days is the most that we've seen since 2022, which is another legit bear market. We've only seen that 7 other times going back to the year 2000. And on every single instance, the S&P was down 25% or worse. That we've seen that. So again, that is a classic feature of when the S&P is down big, you get those huge swings in the 10-year. Now, I want to take it a step further and say, okay, great, we have the carnage.
Yes.
I just don't know if it's gone on long enough to really register.
You've got the market down 15% from highs, 18% for the NASDAQ. You've got stocks that are down 30, 40, 50% from
Agreed.
their highs.
Agreed.
So I would say, yeah, there's things to be concerned about, but you've got to look at opportunities for the long term.
But here's the problem. Then they
And because of that, a lot of the risk has already been taken out of those.
So you buy a stock 35% in the hole, come out with earnings not as bad as feared. Maybe they even give guidance. 43% of companies in the S&P 500 give sequential guidance, so that would be great. And then the stock rallies by 10%. You say, I made a great buy. And then a week later, it's rolling back over lower lows. This is the main concern right now, I think, amongst.
Sure, a concern, but as a long-term investor, you just buy then too. Buy in a month when the lower lows are hit.
Wall Street strategists. It's not, are these stocks compelling values? It's, is there a trapdoor in what looks like it should be the low?
And one point to add to all of this is why I don't mess around with margin and invest with borrowed money, because you never know what's going to happen. You never know what the short term is going to look like. There are these really unexpected swings, and the market can be so manipulated that it's just overall a bad idea, in my opinion. So next up, we have the news from the recent Amazon annual shareholder letter. And this article here says Amazon CEO sets out AI investment mission in annual shareholder letter. So obviously I'm interested in this for the future of Amazon, but also the future of AMD. Obviously with more spend, it's going to be more revenue for companies like NVIDIA and AMD and ASML too. So this article says that Andy Jassy, the Amazon CEO, on Thursday justified the company's billions of dollars in outlays for artificial intelligence development, saying the investment was necessary to remain competitive. Quote, if your mission is to make customers' lives better and easier every day, and you believe every customer experience will be reinvented by AI, you're going to invest deeply and broadly in AI, Jassy wrote in his letter to shareholders, an annual rite of passage for the top boss at the Seattle retailer. He said substantial capital investment is necessary to obtain AI chips and build data centers. Our customers, shareholders, and business will be well served by our investing aggressively now, he said. Like rivals, Amazon is investing heavily in generative AI, including releasing a variety of chatbots serving sellers, businesses, and consumers. Last month, after multiple delays and billions of dollars of investment, it unveiled an AI-infused revamp of its Alexa voice assistant. Amazon has also invested about $8 billion into AI startup Anthropic, and has incorporated its Claude software into what it is calling Alexa Plus. Jassy's comments on Amazon's AI spending echo what Alphabet CEO Sundar Pichai said on Wednesday at a Google Cloud event. So both Amazon and Google recently confirming that they're spending more. Pichai reiterated the company's plans to spend some $75 billion this year to build out data center capacity, and defended Alphabet's massive jump in capital expenditure, saying, quote, the opportunity with AI is as big as it gets. So there's been some uncertainty around this, if big tech is going to continue to spend heavily. But as I've said in the past couple weeks, the past couple earnings calls and the numbers that they're giving show no indication of that. And this just confirms it. And talking about tariffs again, this was kind of his response. He says, people have not stopped buying. There's certain categories where we do see a little bit of people buying ahead, but it's hard to know if it's just an anomaly. We haven't seen any change in consumer behavior in a meaningful way yet. Amazon is one of the companies I've been buying the most heavily recently, and really averaging up on my current position. And the reason for that just goes back to, I still believe that Trump with these tariffs, it's a negotiating tactic. He paused tariffs on everyone but China because he had I think I saw news that he had offers from 15 countries on the table. So he said, all right, let me pause this. Let's see what we can work out. And ultimately, if you think a couple years in advance, by the time midterms and the next presidential elections come around, he's going to want to be popular among the people to set up JD Vance for potentially another 8 years. And I think to get that, he really has to have the consumer feeling good, in terms of prices on items and work and housing and their retirement accounts in the stock market. Keep in mind that a lot of the donor money that he and the party gets is from wealthy individuals that have millions or billions of dollars in the stock market. And ultimately, this is such a earnings and profit driven country that's what the people are going to want. That's my opinion. Let me know if you agree with that in the comments, but that's how I see it. And that's why not Walmart, Amazon has been one of the most attractive buys for me right now. Not to mention they have all their other, the other pillars of their business. You have AWS, you have advertising, and then I don't know if it's an official pillar yet, you have AI, things that are all growing much faster than the e-commerce business and are going to be impacted less by tariffs. Okay, lastly, let's review my portfolio. So in the past week, I'm up 10%. The portfolio is sitting at almost $73,000. If we look at my positions, here they are. Some of them, AMD, are getting pretty well into the red now. If we sort this by total return, you can actually see that Celsius is the biggest gainer. Not too long ago, probably 2 or 3 months ago, I was down like, 25, 30% on Celsius. Now I'm up, I think, 30%. So it just shows how quickly things can change. So if we look at my history here, let's look at the past 2 weeks to see what buys I was making. Let's see, April 1, SoFi. I'm really liking SoFi for the longer term future. I think they're going to be a banking giant. So SoFi at $10, $11, I'm going to be buying. Same with Amazon. Here you see 10 shares at $188. Here's where I started my Google position. 4 shares at $154. More SoFi, a little bit of Shopify, more SoFi. And yeah, that's what I've been buying. SoFi, Amazon, Shopify. I'm liking all of those right now. SoFi and Shopify are both companies that in the past couple of months have kind of seen insane valuations, but now they're finally coming back down, so I'm able to add to those. If we look at Qualtrim here, where I track my portfolio, they have this dip finder feature. So this is just a watch list with all my holdings in here, and you can change this here to 10-day, 50-day, 100-day simple moving average. So we can really see which companies have been holding up in the past couple of months versus which ones haven't. And Celsius, as you can see, it's the only green company in that time period for my portfolio, up almost 30%. Elf, Shopify, and SoFi, on the other hand, are down significantly. And what you can see here is Google, ASML, Uber, Celsius, all of these companies or all of these stocks were already hit so hard and the valuations were already low. So you're going to see, a lot of the time, smaller drops in those. But to summarize everything, I think every company in my portfolio right now is a buy. So that's the trouble with, a decline in the market. Ultimately, there are just too many opportunities. It gets hard to pick which ones are the best ones. And yeah, that's what I'm trying to do right now, figure out which ones are the best ones. But, the short term is going to be what the short term is going to be. I'm thinking long term. I continue to invest in great companies with great balance sheets, tons of cash. So they're going to weather whatever is thrown at them, tariffs or whatever. And, when you think about a lot of these companies, like SoFi, like Uber, a lot of these companies won't necessarily get hit by tariffs, but the price drop related to those is just the market, factoring in the possibility of a full-on recession. So just keep that in mind. But that'll be it for this video. I'll see you in the next one.